You recently put out this letter to community, is what you call it, where you literally published all of the fund's performance to date. Shared some really interesting stats on where the companies are located, how they're doing. This is all publicly available, so we'll include a link to the show notes. But tell me about this report, what prompted you to just share this with the world, and what's the reception been since you did put it out?
First of all, I think being a good community member requires transparency, right? And it's one of the, I think many angel groups don't talk about their results, and I sort of don't know why. Like, it's not a huge competitive thing, or like, it's not like I'm trying to run a venture capital firm and get $1 billion under management and make a bunch of money off management fees.
What?
Right?
That's not your plan.
That's not my deal. It's not my end game. I think it's important. I think it's important for founders to understand the investor perspective. And so that was an audience that I had in mind when I was publishing this. Some of it was I wanted to publish and perhaps try and influence others that are investing in this space and that we at times co-invest with. And admittedly, it's easier to be transparent when your numbers are ahead of the median, right? And you're sort of like, hey, I have good numbers. It's easy for me to talk about this.
That's so true.
And we've been fortunate to have some success, so it was easy for me to talk about. But I also tried to, in that piece, talk about what I see as some problems in the space right now and in this sector. And I worry that as a whole, angel investors aren't achieving the overall return on capital that's going to be necessary for this activity to continue at the pace that I would like to see. And
say more about that.
Yeah, so I think that I have a fundamental belief that, let's talk about pre-seed investors, right? So if you're investing pre-seed, that you should, if you invest really early in a company that exits for $50 million, I think that should be an outcome. The reward for that should be a financial outcome that positively influences the overall return of the fund, right? First of all, creating something with $50 million worth of value is hard, right? That is, there aren't going to be a lot of those outcomes. So if let's say for my fund, and I think this is a fair benchmark, let's say you're trying to produce a 2.5x return on capital, right? Just cash on cash multiple over time. Okay, so if I'm trying to do that, and let's say that my average pre-seed deal today is raising on a safe with a $10 million valuation cap, something like that, right? So let's say I go into that deal.
No discount.
And yeah, so
the YC safe.
10 billion valuation cap, 10 million post-money cap, no discount. I'm in that deal, right? And let's say that over time, the company, they're not just going to do their pre-seed round and exit for $50 million. So there's going to be some dilution along the way, probably meaningful. And so, let's say, I don't know, at exit, maybe there's been dilution to where my stake in the company has been cut in half from where it was when I first invested, right? Every company is going to have its own story, but so now if my equity interest has been cut in half through dilution, I'm now effectively in this deal at 20 million valuation instead of 10. It exits for 50. I have a 2.5 cash on cash return that doesn't negatively impact my fund because I'm trying to do 2.5x overall, but it also is not a contributor to an over the benchmark performance, right? Despite the fact that I think a $50 million outcome is really, really hard to achieve. I believe that pre-seed investors overall, that needs to be a 5x return on capital sort of a thing, right? To have given the distribution of angel investment outcomes on a deal by deal basis, if that $50 million outcome, if I'm doing pre-seed deals, if that isn't doing 5X, if that's not a deal where I'd be telling my neighbors about this awesome deal I was in versus, yeah, it took 10 years. I got 2.5 times my money. Like, it's probably about the S&P, right? So I didn't get hurt being in this, but it wasn't like, oh my God, let me tell you about this windfall I had, right? I worry for the category of angel investors as a whole for that reason, because I think that those type of exits aren't being adequately rewarded. And the other side of it is, I think therefore it's going to lead to, I think it leads to some founders who are worthy of backing not getting backed, who maybe their outcome is reasonable to think that they could exit for 30 to 50 million, but that deal's got to be appropriately priced. And like, it can't be at the median of what the Carta data says that pre-seed deals are, right? Those deals are worthy of getting funded. They're just a lot of them in market at a price where on the investor side, it's hard to make the math work.
A quick note before we continue the conversation. Alongside the Diligent Observer podcast and newsletter, I also run an outsourced operations service specifically built to serve angel networks. My team handles things like initial screening, social media, newsletter prep, platform management, and a whole lot more. The kinds of things that either aren't getting done or shouldn't be done by busy community leaders. If that sounds interesting to you, send me a note. Now, back to it. It's interesting to hear you describe all this because we've talked at length on the show about the craziness that is pre-seed seed pricing and how just disjointed that can be, where right now like Series B-ish is particularly cheap, quote unquote, relatively speaking, which I had Peter Walker on the show recently to talk about a lot of this. Where do you think this change started? Because the sense I have is that it wasn't this way, a decade ago when you were getting into this, but that over time it's just creeped up and up and up and up. When did this happen? Why do you think this change has happened to make pre-seed so unapproachable?
I'll take you through the continuum. When we started Charlotte Angel Fund, the standard ask was, convertible note with a $3 million cap. I would say that was like middle of the bell curve, what people were coming in and pitching. Then it moved to 5. Now it's probably 10, right? Part of it is there are larger magnitude outcome opportunities out there, right? It's easier to exit. There are more exits for $1 billion or more now than there were 10 years ago. I believe that, right? Here's the challenge. So you have to ask yourself, if you're sitting in a community-based angel investment group, do I feel like I'm going to have reasonable opportunity to consistently access deals that are in let's say the top decile, right? The answer for most groups is going to be no, right? No, I probably am not. First of all, some of those top decile deals are never going to raise angel capital. Founders have that capital already available to them, whatever. They're not going to show up at Charlotte Angel Fund and pitch, right? And so, okay, you got to be realistic about what deal flow you think you're going to be able to access. So there's more chatter than there used to be about, I think founders are more worried than ever about predatory investors and, losing control and lots of stuff like that, right? Because it's easier for those stories to disseminate when you've got, online platforms to be able to post those on versus, I guess 25 years ago, if you wanted to share a founder horror story, you had to do so at some sort of in-person local meetup, right? Now you can just post it on LinkedIn about, I built a company, it had a $500 million exit and I didn't get anything.
Well, and they're fun to read too. Like I was just on LinkedIn and ton of comments about VC horror stories. Like that's interesting. I want to hear the tea.
It is interesting. I do think to myself, well, if you went through 600 million of capital to get a $500 million exit, really, how much should you get? Right? Your value creation, I guess, was negative 100 million. So What are you entitled to at that point? And so, I think founders are more worried about it. I think there are more and more people in the ecosystem telling them, you shouldn't give, don't give your company away. Don't do this. Don't do that. YC has, Y Combinator has gotten, has certainly pushed some of this, but again, that math works for them because they are shopping in the top decile of deal flow, right? And so, okay, they can just have their standard deal be, a safe at whatever post money, and that's going to produce a certain profile of return for them versus if we just invested in 20 pre-seed startups from the Carolinas at, 20 million post-money safes, just all of them, right? We'll do the best 20 deals we can access, put money into all those at a 20 million post-money safe at pre-seed. I'm confident that we'd have less than a 1x cash-on-cash return.
Thanks for listening to this episode of The Diligent Observer. I'm your host, Andrew, and if you're an angel investor looking for essential angel intel in 5 minutes every week, I think you'd enjoy my newsletter. I send my best stuff, interesting deals, and more straight to your inbox so you never miss a thing. Subscribe today at thediligentobserver.com.